What up, Outliers? Hope everybody's week is off to a stellar start, hopefully. And we have a bit of an agenda for today. As I mentioned already, I made a couple posts about it. I'm opening this one up kind of to anybody that wants to hop in. It's mostly just because this was a really interesting trade, and it's something that I want to talk to people about so that you can understand a little bit about the way that we can add a lot of leverage to a position, but do it kind of safely. And that's what I want to talk about. Now, there's a couple caveats to this because the trade that we're going to be going through is super risky. And it is so important to note that for anybody that's going to follow along with specifically this part of the video that's diving into this trade. So let's talk about the position and what happened. Obviously, we got to navigate away from GameStop. This is what I was talking about in the recap video earlier. And let's grab the Russell. Now, for those that don't know, I trade the Russell a lot, and there are a lot of reasons why I trade the Russell a lot. It's primarily because leading into really the mid 2000s, growth stocks, smaller cap stocks, actually outperform large cap very frequently. Now, the drawback to that is they often have heightened volatility, meaning the variance of your position will move a lot. That's the trade-off, generally speaking. Then we kind of get into this technology revolution that really starts to change things. And we now typically think about tech as the primary driver of value. And I think a lot of people are very, very used to hearing tech as, you know, the belle of the ball where all the value is coming from. And that's not a common phenomenon over the history of the market. That is a temporally relevant phenomenon of the market as it pertains to how things are today, but it's not how it always was. Okay, so when I first started trading in 2007, there was still a lot of back energy driven from something like IWM. And small cap products like the Russell, they offer really interesting trade-offs. One of them being, if you're trading options, you normally will get more money per dollar from something like the Russell. Now, again, this is all the background behind the product. And I think it's important to have some of this background for the trade that we're going to talk about, which is essentially over the last couple days in the Russell, I've made over $100,000. That's not even all the individual positions. That's just kind of like a core allocation of the position. But all of that is predicated on all this bullshit back end stuff that I think is worth kind of sharing with you. So as we take a look at something like IWM, and if we look back over essentially its entire lifespan, we can see that it moves well, right? So it definitely exhibits standard market propensity, but it does not follow the same volatility profile. And we can use tools like Portfolio Visualizer, for example, which is a really great tool to take a look at the performance of these things. So let me grab that and we'll take a look at this example together. And then I also realized I need to shoot an email. I'm supposed to be talking with my market maker friend at 1800 tonight. I just got to let him know I might have to push us like a day because I don't want to cut this stream short. I just shot him an email. I don't want to leave him hanging. Thanks. Okay, so let's get back to this and let's take a look at back testing a portfolio. And let's take a look. We're going to edit all this, clear this out. Let's take a look at SPY or soy if you're interested in misspelling, and then IWM. And then let's take a look at 100 and 100. Now, first, let's analyze these, and we'll do from 1985 to 2024. It'll obviously start when, oh, that doesn't look right. Oh, is it because of VNIX? Why does it only go back 15 years? Hold on. Maybe if I get rid of this, because both SPY and IWM have been around longer than that. Is it just a limitation? Ah, there it is. This makes sense. Well, that complicates the example a little bit, because I was going to say this isn't right. That's kind of annoying. So maybe this will still show some of it, I guess. So yeah, this still shows some of the point. What I wanted to show you, and I can build it really fast and I'll post it for you just so that you can see it. But what I wanted to show you is that if you go back far enough, you'll actually see periods like this, like 2015, 2016 through 2017, like essentially up until 2018, you'll actually see large caps and small caps have a very tight relationship. And this is actually later into the relationship span where if we could go back further, you'll actually notice growth stocks like the Russell tend to outperform. But it's just like this is narrowing down because we can only go back 10 years. And then obviously you can see that relationship narrow widely in the last 5 years or so. So that's kind of the background behind the product itself, I guess the securities itself. And why this generally matters is because it tells us the behavior of things and the relationships of things. So then we knew that we were coming up on a Fed rate cut. I don't think that was a shock to anybody. And my journey started with M2K. And the reason why I use the micros is because these are futures, by the way. And the reason why I use the micro futures is because I can get very specific with my risk. And the way that I think about this is even though I could easily put on, again, like if for every 10 lots that I pick up in M2K, I could use just one in the Russell RTY. But sometimes I will prefer the ability to pick up a 5 lot, then a 5 lot, then a 5 lot, then a 5 lot. So then I can do that in M2K to get the correct exposure that I want. So that's why this journey begins in M2K, which we'll talk about. Now, I realize that I've been a giant selfish asshole and I haven't said hello to everybody, honestly, because the chat normally is over here, but it delayed opening up. So I have to say hello to everybody. So I see we got IR2 Bad, Ty, Joey. We got Shrey J. Shrey J, you are the man. Shrey J is going to offer one goat to the IWM gods, which I think we could all use. I'm out of IWM now. I'm out of Russell. So honestly, whatever the Russell chooses to do at this point is up to the Russell. But we'll see how that goes. I see Mac, Chicken, Elong Song, Zachariah, Sam, Reese. We got Joey. Daniel's here. For those that don't know, Daniel has like 36 kids. So he's probably wrangling children right now. He's like my surrogate. I consider him like my surrogate parent because I'm still being super selfish and not wanting to have kids yet. And he's out there doing the Lord's work. I think Elon would appreciate his efforts tremendously. So Dan, you're the man. Thank you for doing that. We got Paulo, Marcus, Mike, Mashton, Dark Mark. Oh, shit. Oh, shit. There's Dark Mark and Light Mark. Got to be careful with that. Daniel says, absolutely wrangling kids right now. See, that's the problem, man. Right now, if I showed you Thor, he's curled up like a little donut in his bed, completely sign it. Mock says mock, not Mac. Got it. Mock chicken. I guess, I don't know why would I default to Mac? I definitely wouldn't go to mock there. So that makes a lot of sense, to be honest. But yeah. And we also got Shatter. That's a fun name. Cool. Okay, so Fed gonna cut rates. Now, the reason why I'm going all the way back to this, to the beginning, is because when I tell people that I had a series of really good trades in this move here, I don't want people to latch on to the really good trades. It's actually not the point of this at all. It's to talk about the journey of these trades, how often the position didn't work, what kind of pivots needed to happen, and then what ended up culminating in a series of good trades. But so the Fed rate cut, for those that don't know, was all over the map. if we go to the Fed Watch tool, this is one of the cool things about the Fed Watch tool. Normally, I just use the bond market when I'm trying to look at what I think the Fed rate cut will do, because you can kind of just eyeball it using the SOFR bonds, the ZXs. But if we go here and we take a look at the 1 May 2024, and let's take a look at the probabilities. And the reason why I'm using the 1 May 2024 here is because this is how we started towards the beginning of the year and how I started positioning the portfolio. And a big part of the portfolio at the time was essentially saying, okay, do I think that there's going to be a rate cut? Yes. And what do I think it's going to be? Again, this is kind of the rate as it was. And let's take a look. So leading into the beginning of the year, January, the probability of rates staying where they were, which again is this line, you can see it down here. The probability of that happening was 0.63%, essentially null. So then that tells us at this point in time, there was a absolute favor for a cut of some sort happening at the 1 May meeting. So it started with a 22% probability of 25 basis points, a 68% probability of 50 basis points, and even a 9% probability of 3/4, which is huge. So this means I start positioning. And the reason why I start positioning is because I know the market is not going to wait until the cut happens itself. The market is likely going to start front running the cut. Now, for context, why do I care about the cut? I don't care about the cut. It's just a catalyst. So this is one of a bunch of different views that I have. This is just kind of like a simple one that shows me, for IWM specifically, the movements over the last 100 years on average following every single rate cut. So it doesn't matter if it was in 1990. This is like an overview. And for those that might be struggling to read this, these two are kind of the extremes. So the blue and the red. The green is the average. Now, these aren't actually negative numbers, by the way. That's just like a dash. I don't do visualizations. I only do visualizations when I'm doing stuff like this for you guys. I just look at the data. Like I couldn't care less if it's on a chart personally. But I know a lot of people, what I would look at would probably put people to sleep. So anyways, that's just an ism, right? These are just little hashes to show you the level. It's not a negative. These are all positive numbers. Now, this is showing the performance following a rate cut, again, on average over the past century. So we can see over the past 1 day following the rate cut, it's slightly positive. It's like, I can tell you the exact number really quick. It is 0.036%. And then for 2 days, it's 0.071, 5 day, 0.174, and so on. So there's positive movement. That's what I can tell you in small caps following a rate cut on average. And again, this is the macro view. For me personally, I break this down into an Excel sheet and then I weight them by time frames, kind of mimicking an exponential moving average so that I can get really specific. All of this is to say that probably, I don't know, maybe not a ton of research, maybe like 6 hours or so total. But maybe about 6 hours of research I put into this general idea and to confirm what I thought may or may not have been likely to happen. And I felt fairly confident that when there was a rate cut, there would be a front run move, because I also look at the movement leading into the rate cut itself. And I can clearly see that there's some preemptive bleed through for sure. Meaning people know it's coming and it starts to get priced up, which you'll see in this example. And then the second thing is I know based on recent price patterns around more recent reference cuts, and I try to analyze what the prior inflation period was to even create a correlation between those. And I felt pretty confident that there was going to be a rate cut. And I think that that's a really, really important note, because confident is not certain. This is still a trade. So when I recap the overall thesis, there's nothing special about trading this Fed rate cut. I think the only thing about this that made it kind of interesting is the way that it went down is different than I expected. So let's then take a look at the chart and then we'll talk through a little bit more in detail. So what I need now is this. Let's grab this, and here we go. So a couple things to note right from the jump. The first one, we can clearly see that this already started a little while ago, right? This move didn't happen just out of nowhere. This move in the Russell started because the Fed was originally talking about cutting rates a little bit sooner. And we can take a look at an example for that. I'm going to take it into year to date so that you can see. So beginning of the year, it looked like we were going to see the rate cut, right? Then we can see as time passes, we move forward to February, we can see that the probability of no cut starts to rise, and it starts to rise, and it starts to rise. Okay, fine. So then we get to May, and obviously we don't do anything. We keep rates. Okay, so then we go to June. So then if we look at the June probabilities starting from May, you can see that there's a lot of different possibilities, but at this point, the market is essentially favoring no cut right from the jump. So once we kick the can from May to June, the market kind of holds that consensus. It's not like it's whipsawing back and forth. It's that originally the probability of a cut in May was pretty high, then it came down, and then it stayed low. So then that tells me need to reposition the portfolio. So then for all of those that have been following my work, and again, it's not just for the Patreon folks, this is stuff that I'll generally overview on the live streams, but that's why I didn't have a whole lot on in small caps. I was trading them here and there, but not much. And it's just because the thesis had been disproven at that point in time, and I was waiting for conditions to reconstitute into something that makes sense. Okay, fine. So then we look at the 31 July scenario. And again, we'll pick up from June. And let's take a look. What's the probability of no change? Again, the lowest it got from that point is right here, which was 78%. Again, no change. Nothing fun going on. Then we get to 18 SEP. So if we go forward from July, now it starts to get interesting. Because looking forward to the 18 September meeting from 31 July, where the last Fed was, you can see a fascinating change. Take a look at the probability of no change now. It's down to 35% chance, much, much lower. Then we can see the probability of a cut of 25 bips at 60% chance. So now it looks like we're on a pretty clear on-ramp to a cut. If we take a look at when we started seeing this up move, it was on July 11th. So what happened here back in July? Why did this matter so much? Well, when we got through this last Fed meeting and we had gotten some new economic data, that's what started to look like the Fed's hand was going to be pushed. So here, I actually traded this move, and I already recapped this whole move. I'm not going to talk about this one because it doesn't matter, but I traded this move, and this move surprised me a little bit because this was a really strong front run before the Fed cut. So I caught this move late. I started getting in as it was like way up here already, later than I wanted. And realistically, my ideal target would have been as it's breaking out above here. I want to get in like down at this bottom level if possible, but I didn't get in this as early as I wanted, at least at size. I had some small carry positions in there, but nothing that really was going to move the needle in a meaningful way for me. Okay. This goes on. I end up getting stopped out. I got stopped out like right in here. It was like a super boring, short-lived trade. I mean, it was good money, but it showed me something that was very important, though. Very, very important. The thing that this showed me is that the market was going to try to front run this move. I could see it clear as day. That's what caused this, is trying to front run the cut. Then we have more economic data came out. Market, this is when we had that pretty big broad market correction during, what was it, August, the beginning. I think I was in Alaska traveling at that time. I'm pretty sure I was traveling that time, because as things tend to have it with just funny timing, it seems like when I think you guys pointed this out to me. There was a couple people in the Discord that were like, dog, every time you leave, the market starts to crash. And it's funny because most of the time when I'm leaving for trips like this, I don't generally flatten all the way, but I take my risk down to, again, not fully null, but pretty close to null. And it's because like I'll still trade for sure while I'm traveling, but I'm very, very cautious about having positions on that really require me to do something. I don't want that, right? I like to trade. I love trading, but when I'm traveling, I want to trade because I want to. It's not because like I have to manage these positions. Shrey says that was Dan. Yeah, I knew it was somebody that called me out on that, which is just hilarious. That's exactly what happened here. That's why I remember this. The timing of this was so funny, because as things started cratering, I already got stopped out on small caps. I was like, damn, this sucks, whatever. And then anyways, this move, I didn't participate much in. So this move in and of itself also surprised me, and I didn't trust it literally at all. So what I had in here was some really small Russell positions in the micros. And again, that's not going to be part of the trade review that I'm going to get into in just a few moments. This is more just what I call them carry trades. I tend to have a long disposition in the market and follow the momentum. So in this case, it literally just triggered a couple entries based on momentum. This was not like a specific Fed cut play, anything like that. That's all. Then we start cratering. And this is where I got really, really interested, because the timing of this couldn't have lined up more beautifully, because I already analyzed my like trade log, which, as all of you know, I am very, very, very committed to talking about trade logs as much as possible because I think they're pivotal. And I was analyzing my trade log, and essentially, if we had been up here, I would have still traded the cut, but I would have made a fraction of what I made. So this drawdown is essentially what provided the profit opportunity, because I scaled in way heavier earlier than I would have had we been here, because I would have been a little bit more fearful of the downside reaction from here, because again, I have a clear reference of what the downside can look in these periods. And the Russell downside this year has been aggressive. So that's another thing that's just in the back of my mind, tracking this kind of move. So I see that the Russell has been, I call it emotional. It's not really, it's a bad term. Honestly, it's me being lazy with terminology. Really, all I mean in that context is that it starts to fly. It's almost like a meme stock. That's actually a better way to put it. This is kind of like a meme stock of the indices. So this provided a really good opportunity. And as we started collapsing, I knew beyond the shadow of a doubt, a trade was going on for me. I knew beyond the shadow of a doubt. So then I decided to start figuring out what kind of trade I wanted to build. And this is what it ended up looking like. So the first trade went on here, then the second, then the third and fourth are here on 2 different days. It's just kind of congested. And then T5 is actually where I was getting stopped out. So T5 in this case, again, being lazy, I didn't do closing trades for all of them. I just wrapped them all up in like a trade 5, which is all my exits. And I will walk through all of them. But I want to walk you through first what I was seeing in here and why I was building this trade as I was. So it first started when we started trending sideways. We're coming in closer and closer to this cut. So what I'm doing is I'm tracking the bond market, and I'm trying to understand why we're being so lazy and why we're being so late in terms of pricing in the probability of some sort of cut, which is highly top of mind for me. So when I'm looking at this, I see, okay, the probability of a 25 basis point cut, about 86% chance. So this case is, okay, fine. My opinion is the market is generally pricing in this probability of a 25 basis point cut that could be even being here from here could be the market starting to price that in, expecting it to be too slow. The market not really liking that. Okay, fine. Then something really interesting starts to happen. when I take a look at the 12th, notice what starts to happen here. So we go from an 86% probability of a cut on the 11th. If we go to the 12th, that goes to 72. If we go to the 13th, it goes to 50. Why do I care about that? Because I'm using reference drops similar to that to understand how the Russell moved and why it moved like that. So as I see this really, really steep decline starting to happen, the 11th, no move yet. The 12th, I'm starting to get interested because it's a big drop. The 13th, now I'm very interested because this is showing me that the probability of a cut being from just 25 basis points actually is now 50-50 between 25 and 50 basis points. And what starts to happen here? Well, on the 11th, we start to get a rally. On the 12th, we see that rate cut drop massively in terms of a 25 bips and the probability of a 50 bips skyrocket, but raised dramatically on a relative basis. So this is where I start entering the trade. Then on the 13th, I see the probabilities continue to assimilate more in the favor of 50 basis point cut, which I've mentioned this a few times. At this point, I don't think that's priced in yet. I don't think the market had priced in a 50 bips cut at this point. And it's because it had been essentially a null hypothesis, meaning that it wasn't in the bond markets that I could see. So then it makes me think that the small caps and other indices, to be clear, are going to have to play some catch up. That's what I think. So now, is this... YouTube just said that it did an ad. Did you guys just get an ad? I literally have ads turned off. What the fuck? Dude, that's so annoying. I literally have it turned off. Ice Egg said no. Reese said no. Mike says yes. Mashin says, what the fuck? That's so annoying. I have to figure that out. I literally purposely turned that off. I don't like that it does. Oh, here it is. Yeah, it's already off. Let me know. That's annoying. Let me know if another one pops up. Because Paula says no ads. Sam says always have ads. I got an ad. That's so fucking frustrating. Yeah, sorry about that. You're not supposed to get those. I literally have it turned off. I just went into the setting because there's a thing that pops up for me that says focus on your live stream and let YouTube insert ads for you because I have ads turned off on the live streams. So then I just turned it was off, but I turned it on and turned it off and then saved it. So hopefully there will be no more of those because there shouldn't be. Okay. Sam says usually Robinhood. That's hilarious. The fact, I'm not even going to lie, the fact that Robinhood advertises on the channel, I get such a kick out of that because I talk so much shit about Robinhood that if somebody got a Robinhood ad during that, I'm not even mad. The opportunity to see Robinhood pay money to post an ad and then I get to talk shit about it is great. I hate Robinhood, actually, to just capitalize on that moment. So yeah, that's awesome. Mock Chicken says lots of Moo and Weeble ads. That's really interesting because Moo, they reach out actually to me pretty regularly to see if I want to be like an affiliate for them, but I don't know much about them at all. TBH. Mike says, can you talk about what you were looking for in the bond market for confirmation of 50 bips cut was not priced in? To be clear, there's no confirmation. It's just a hypothesis. But to your point, the reason why I thought it wasn't priced in is essentially this. If we look at the probabilities going back essentially as far as we can go, the probability of a 50 bips cut being priced in this meeting was so incredibly low. Now, again, what I'm showing you in this tool is nothing crazy. What I'm showing you in this tool, what this tool shows you is literally just this. If you pull up this, which is a futures contract for the SOFR rates, you literally can look at these yourself. and it shows you what the mid price is, what the volume is, those kinds of things. This is showing you what the expected probabilities are of the federal funds rate. That's what this future contract is. So if we take a look at ZQ, you'll see a bunch of different expirations. Like this. So all it's doing is comparing these different futures to one another. And that's 100% how it's coming up with the probability, right? You can literally see the probabilities here. I don't know, maybe you can see if you're slightly autistic like I am, but that's what this represents essentially. So anyways, that's all it is. I use the futures here just because it's easier and I can kind of see it. This makes it, I think, a little cleaner for people to see. It's just a little more aesthetic. And I like this view. This view is convenient for me as well to see all of them at once. That's a new one, peach strawberry. I'm undecided on how much I like peach strawberry, but it's pretty good. Shrey J says, did you run out of the mango orange? Yeah, dude, mango orange is already gone. I already put more in the fridge, but they're not cold yet. So we had to try a peach strawberry, which I just don't know yet. It's not bad. It just doesn't really taste like much. The mango orange is light years better. Sad day. So we start to see this rally. So this is where I start building a position. So let's take a look. This is the first trade that went on. So this would have been, I think, on the 13th. I can confirm for you the date, the 12th. So, and again, I already had an existing position on in here actually from back here, but I'm not counting that in this. What I'm isolating now is the individual position that was built around the Fed meeting. And there's a few things that I really want to drive home in while we're looking at this. Is as I'm considering the position, I'm thinking about always what I think is likely to happen. So in this case, I start again with the micros. So I bought to open 25 contracts and I'm using the front expirations at 21.11.5. Now, what I'm doing here is establishing a smaller base position. So we can see that the notional value is like $264,000. There's rounding in all of this for ease so that there's not a million numbers. And the total margin was about 63K. That's actually overestimating. I always overestimate the margin in these instances. I think the actual margin, this is portfolio margin, by the way, but the actual margin I want to say is probably like maybe 2K or something like that per contract-ish, maybe a little bit less than that. It'll also be dependent on where we're at and what the perceived risk is. So in this case, I think I used 22.5 or 2,500, something like that to calculate the general margin requirement. So this trade went on as kind of like the base trade. This is the beginning of what I consider to be some sort of breakout. So then what I do is I figure out where my stop is going to be. So this is where we're breaking out. I need to figure out where's my relative stop. So in this case, to figure out my relative stop, all I'm doing is I'm citing the previous day. And I'm saying, okay, where did we open on the previous day? That becomes my soft stop. So in this case, I'm expecting to use the soft stop. So I don't even include the hard stop. But depending on how price moved, what it might have looked like, this would have been more my hard stop, kind of like the 2087 handle. And I purposely wanted to draw this with you. So I'm entering here. And price was like, again, I think 21.11-ish, somewhere right around here. So this is where first entry is going on. So my soft stop, I'm using the open of the previous day, essentially, just shy of that. That's the first spot. Now, again, I was expecting to get out at the soft stop if it came up, and then I was just going to cycle right back in if it rallied back up above. This is more so where I would have said, okay, it's not time for whatever reason, trade's not lining up, 2089 is exit, but I wasn't really expecting to get there. So at the entry of the trade, the total risk on this was $1,100. Now, the downside to having risk this tight is the probability of getting stopped out is quite high. So I knew that. And I was expecting again to jump right back in if conditions looked favorable. Okay, great. I'll get right back in. But I wanted to make sure that I wasn't going to get caught if for whatever reason this continued. Because again, going all the way back to why I go through that context with you, because I've seen IWM do these exact kind of moves so far this year, where the downsides have been way less of this kind of downside and way more of these steep drops, right? Like if we look at most of the drops that we saw in this for the past 6 months, steep drop, gradual slope down, steep drop. So that's what I'm preparing for. That's why I have this set so tight. So then that takes us, again, I think that was on the 12th. So then the next day, we start rallying up above higher. Okay, so thesis is on. It's time to start scaling into the trade. Now, in the beginning of these trades, when we're down at these lower levels, I try to scale in more heavily to hit the bulk of what I want to have on at a given point in time. Now, a couple things. At this point, I had zero expectations that this was going to be such a big day, the 13th. This is one of the errors that I made, is I actually should have started scaling in with the broader part of the position. So right now, you'll notice I'm still only using the micros. And the micros, again, are kind of designed as a carry trade, stuff that I would even hold if this started oscillating and going down or sideways. So the first mistake here is, as I saw the residual strength on this day, I should have started adding the positions that I built on the 3rd and the 4th trades. Armchair quarterbacking, right? Looking back, would I have done things differently? Honestly, yes. The things that I would have done differently is not necessarily in the beginning of the day, but I should have been more aggressive. And as it started rallying super hard into the end of the day and being so close on this wick, again, not doing like some sort of candlestick analysis, but kind of doing some candlestick analysis. When I see these big giant green bars that are kind of one-sided, that's telling me the market is moving one direction. It wants to go one way. Right? So take a look at the low of the day. It's tiny. It's this little tiny tail that then surges up for the entire day, and it has this little tiny wick that then comes right back down, and that's where the market ends up closing. So when you see these really big one-sided bars like that, they tend to open up. So I didn't perceive that intraday strength for whatever reason. Honestly, it's probably because I was doing something else. I really don't sit in front of the screen all day. I get a lot of screen time, but not all day. And so I just didn't connect those dots. I didn't make that move then like I should have. I'm still not convinced about this peach strawberry. Reese says, what exactly is a carry trade in this instance? Yeah, so for me, a carry trade is just a position that I'm expecting to hold longer term. Like I'm not just planning on trading that for this breakout for the FOMC. I'm using FOMC as a catalyst to start scaling into it, but I was expecting to hold it through, because I was not expecting this kind of movement pattern leading into FOMC. That's one of the reasons why I showed you at the beginning of the video that reference for standard price behavior after. Again, I have a bunch of different looks that show me leading into, after, and different durations. So in this case, the positions that I'm building in M2K are kind of designed, they're built off of the catalyst of FOMC, but they're not just because of FOMC. I was actually expecting to hold through. But as always, right? It's like a plan survives first contact, and then we'll see what happens. So things changed. So at this point, though, I needed to update my stop. So first trade, I bought 25. Second trade, bought 25 again at 21.59.9. So now my notional value on this one was 270K, about the same. Margin, just about the same. And at this point, total notional value, meaning what the positions are controlling, about $500,000. Total margin requirement, $126,000. So still not using a whole lot of money relative, but I'm getting the exposure that I want, but I needed to update my stops. So this is one of the things I want to linger on. So here I chose to raise my stop, and I don't, in this case, as I'm seeing this movement, I'm not building the stops relative to each position. I'm just choosing a spot that I'm going to scale out if we start dropping. And this is how I increase my notional exposure to $500,000, but my risk actually decreased. The way that my risk decreased is because I now, when I get stopped out on this, am locking in a profit on this original trade. And this profit doesn't completely overwhelm the loss that I would take on this new trade, but it decreases it a little bit. So what I'm doing here is building a much bigger position, but not changing my risk too much. This is exactly how I will use stops to help me get into a highly concentrated position, but not blow out my risk. So this is where we sit now. This is kind of the first 2 days. This day surprised me. After the 13th, I was just like, yeah, okay, I need to actually start getting into this thing because it's moving more than I thought. And the probability of this 50 bips cut is continuing to go up. The market looks like it's pricing it in. So then on my next trade, I move over to the Russell itself. And you'll notice that I start with a bigger Russell position. The reason why I start with a bigger Russell position, in this case, it was a 20 lot, 2207. And the reason why I started with a bigger position is because I felt like I had been a little bit late to the party here. So what I do now is increase my total notional exposure from 500K to 2.75 mil. And my margin requirement essentially doubles from 126 to about 305. Here, I'm using around $9,000 per, I say per lot, that's just actually wrong. It should be options. That's option speak. That's just per contract. But this is a little bit high. Actually, it would have been a little bit less than that. But again, just kind of being conservative with the estimates. So then I update my stops. So now what I'm doing is you'll take a look. Let's take a look at the 13th and then the 16th. So the 13th, we were at 2132. And I'm just using M2K because it doesn't matter. It's the same price if you use RTY or M2K. So if we take a look at 2132, now what I'm doing in this case is I'm using the close of the day. Why would I use the open of the day versus the close of the day here? It depends entirely on where I perceive support and resistance and where most of it is. Exactly why. So here I perceived more support at this level using the open of the day. The other thing is if I used the close of the day, it's just way too tight of a range. So it's not based solely on open or close of the prior day. It's a mix of open close of the prior day, but then also kind of fine tuning it for where I see the best level of support or resistance that I can find. So that's why I use these. Now, in this case, I in no way would use the open on this day because that puts me kind of in a really disadvantageous spot that allows for way too much of a retracement. So especially because I'm starting to scale in pretty meaningfully at this point. So what I do is I slide the stop up to this level, essentially just shy of here, and I'm using this as my reference for support and resistance. Where these touched, where these three touched, that kind of thing. So now with the stop at 2183, the risk on the first two trades is actually positive, locking in a profit about what, like 13 grand or something like that. And then this new Russell position carries a much more sizable risk, right? $24,000. But again, because I'm using the same stop and I'm scaling in on the way up, I'm essentially using the profits from this to subsidize the risk on this to keep the total risk well within portfolio limits. So here is, again, a really important example. I've increased my notional exposure from $500,000 to $275 million, to $2.75 million. And the only thing I've done with my risk is slide it up to $12,000. So at this point, my perceived return on risk is really good, and it's time to continue scaling into the trade. So that leads us to the final position that builds me out to the total risk that I want, which is buying a 10 contracts at 22.15. So kind of continuing to follow this inside day up. That adds another 1.1 million in notional value. So total notional value at this point is like 380, I don't know why I keep saying 385. I guess I think I'm roaring kitty. I'm not, I'm a fucking peasant. 3.85 million. It's sad when you look at that compared to roaring kitty. God damn it. You think you're doing well, and then you just see somebody that's up $250 million, and you just realize, like, you got a long way to go. A long way to go. Jokes aside, builds me up to $3.85 million. Total margin account used at this point is about 400,000. Again, this is slightly elevated to the upside. What's my total risk in the trade? I literally decrease my risk. So there's another prime time entry. I roll my stop up to 21.98 in this case. So the risk on the first two trades takes me to 15K. The risk on this second trade comes down from 24 to 9,600. Trade 4 risk is this one here, comes out to 8,700. So now the total risk on the portfolio is 2275. This is why I wanted to do this stream for everybody and not have it just for the Patreons, is because I wanted to talk about this exact process so that people understand this idea of, as I'm leveraging and as I'm adding scale and scope to the portfolio, I'm doing it in light of my risk. So I'm building into things and I'm using the profits, locking in profits with stops. That's the cool part about futures. They trade 24/7 almost. They close a little bit from Friday afternoon to Sunday afternoon. But there's a way for me to exit if the stops get hit. So even though at this point I have a pretty big notional exposure, almost $4 million, the total risk on the portfolio at this point literally has come down from 12 to 2,300 bucks. So then that leads to the unwinds. Now the unwinds were really interesting. These happened a little bit differently than expected. And it's because of, take a look at the difference on this day. If we take a look at the 18th, look at that candle. Let me zoom this in a little bit more, go like a 3-month daily. Look at that candle and compare it to these candles. What do you notice about the 18th candle, meaning the 18th of September? What do you notice about that candle compared to what you notice for the 4 preceding candles? What do you see? It's a really important differentiation. Profit taking went all over the place. Profit taking could be, it's hard to tell. Definitely people entering and exiting, though, to Marcus's point. Reese says went all over the place. Definitely had a big movement. Up and to the right says very small body. Exactly. So what I notice here is when we're looking at this, it is absolutely pivotal to understand the way that the underlying is moving. So here, if you take a look at the tails, right, the downsides on all of these, there are these little tiny tails. So what's happening is the underlying is drifting down. And again, here, it opened at 2204, and then the low it hit was 2198, like a 6-point down move. And then here, it opened at 2212, the low was 2207. Another like 6-point down move. So, well, 8 whatever it is. So the point here is there's just not these big dips and then rallies and then dips. Here, we have a completely different story. It opens at 2232. It hits a low of 2219. So this goes for almost a 15-point trip to the downside before it starts rallying. And then as it gets to an extreme to the upside, it starts getting pressed back down. So what ended up happening to me is I was using stops based on the prior day movement, and I was sliding those stops around that ended up just dumping me out. That's exactly how it went. So essentially all on the 18th, it wasn't the intention. It's not what I was going in there to do. But I essentially had an initial series of stops set at 2270. That was to profit take on some of the bigger positions from these down here. And then I had the bulk of the positions come off at 2260. And then I had 2250 is the last handle. So I was getting stopped out essentially all day on the downside. And what I was hoping for is as we hit towards the high of this candle, that it was at least going to bite and show some sort of strength. And it didn't. It just kept going right back down. So I got completely wiped out here. Now, for those that were on the live stream yesterday, you know that I put on another trade. I actually put it on last night when we were on the live stream because it was showing strength again. And that drives home another point that I want to make abundantly clear to us is that as I'm entering and exiting, I'm not exiting and thinking like, oh, okay, I'm done here. Hands are washed, time to move on. I'm exiting to protect the positions, to take the profits that were there. But as soon as it starts showing a day like this, which is more so what I expected yesterday, then go right back in. It's exactly what I did. So that's not part of these trades here. That was a trade that I took down earlier today as well, but that's a completely different position. But that's essentially the way that this entire position unfolded for me. So what this ended up looking like was, it was like just over $100,000 again on just these trades. There was a little bit more to it with some of the other positions, but this is kind of like the core. So 102,025, and then the total margin requirement was like $400,000 ish. So then that gives me about a 25.5% return. So good return, but not great. This is way more like my style of trading as compared to a lot of other people, because you'll look at somebody like Roaring Kitty again, who will have like hundreds of thousands of percent returns. But this is kind of how I do business. I'm not afraid to use more of my money, but then I'm going to have a really, really careful game plan in mind for how I'm going to use the capital. And the whole point of committing capital is I'm not going into this saying, okay, I'm going to risk, my total even margin above value. Like I'm not coming in here saying I'm risking $400,000. That's just what it takes to put it on. I'm tracking my risk exactly as I'm defining it. And I think Shrey had a question above. Shrey says, how are you thinking about scaling stages and initial size as well? Yeah, so in hindsight, I scaled too slow. Now, in terms of not knowing, and the reason why I call that out is because I do this, it's one of my isms. It's one of the problems that I have with trading in general. And I've talked about this before, even during the COVID drop. So if we go back to COVID, and I was trading IWM at that time, but I was scaling in on the way down, but I was still scaling in too slow. So what I notice is I'm a little too capital conservationalist when I'm going through these different movements, and I probably could stand to size up a lot, especially with the size of the trades that I'm putting on relative to the stops. I think it would just make a little more sense. However, the one thing that I always go back to on why I do this is specifically for this function, because by scaling in a little bit more slowly, it lets me build profits on stuff like this that then overwhelm the new risk that's being put on, or at least help offset it. So I think that's why I continue to scale this way. In terms of size, that was fine. I did exactly what I expect to do, right? Have the bulk of the trade go on early. So the first 3 trading days, the overwhelming majority went on. Then I had a little bit of cherry to put on top leading into the cut itself. But yeah, that I think is like the bulk of the trade. So initial size, I think, was a little small, meaning I probably could have combined these two on the first day, logically. And then these, I think, are completely fine. And then when I look at these two, I think these were fine. Yeah, I probably could have started with the Russell a little bit earlier. But Mike Will says, if JPal said no cut yet, how quick could you get out? As soon I had stopped sitting there. So literally as soon as price traded around my level, I would immediately get stopped out. I'd just rest the stops. Off Putin says, it works for you. I can never trade your style. My eyes would roll to the back of my head and I'd doze off. Yeah. And I am probably like one of the biggest proponents of trading should be completely boring. Like, I think if you're trading for entertainment, go to Vegas. You are in the absolute wrong business. if you are in trading for anything other than effectively making money, then it's the wrong place to be. Like if there's an entertainment aspect to what we're doing, I think that I am way more entertained literally going to Vegas, playing craps that has a slight house edge, laying odds, and easily, just running that for sure. That's way more fun. You get to people watch, you get to banter with folks. But yeah, I completely agree with you. The way that I trade is replicable, and it's straight up how I've made my living. So yeah, I hear you. Vladimir says, I hate Vegas. What I trade actively is a very small slice of the pie. Yeah. And again, that might work well for you. And again, to me, even doing that, like, I can see how somebody might think that trading could be, more fun than a place like Vegas or something. So yeah, I mean, if that works for you, that works for you. Joey says, is this reproducible in a smaller account, say 5 contracts in M2K? Sure. You can literally, this is why a lot of times when I'm talking about my trades and stuff, I do not at all, like you can get rid of the size on all of these, right? The size doesn't matter. You can scale them all down to 1 or 2 lots or whatever it is. And the concepts of the thesis remain the same. The only difference is depending on the relative size on when things go on and then what your risk is at those points. That's different for sure. But other than that, it's completely like all of this stuff I think it's completely agnostic to size. I think the downside again to like you have to trade in accordance with you. And obviously, exactly as you said, right? Like not trying to follow exactly, but if you would recommend this. Now, in terms of I make no financial recommendations. The way that I talk about trading stuff like this, and I talk about my experience and the way that I do things and the way that I think about things. I literally can't make a recommendation for somebody else because the primary reason, and it's not because like I'm scared to say like, oh, I think this makes sense for you. I actually can do that functionally. But like technically speaking, there's nothing wrong with doing something like that. But the thing is the reason why I say I wouldn't recommend it yay or nay is because it entirely depends on you, right? So like if you look at this at a smaller size and you think like, yeah, okay, this looks great. It's also because the trade worked out really, really well. So when you look at this, if we take a look at, let's say M2K or M1K, that's actually funny, M2K, because there's also, again, like I'm showing you what happened and has it played out, but there's plenty of instances that played out differently, right? So one of the things, and that's why at the beginning of the video, I tried to give you guys such a lengthy preamble about the trade leading into this. Because you have to remember, before I even placed these trades that did pretty well, I placed dozens of trades leading into it that have just done nothing, gone sideways a little bit, gone down, take a small loss, get back in. So the reason why that matters so much is because the way that I trade, I'm able to say like, yeah, okay, I got chopped up half a dozen times before this, but like, I don't care. I'm going to play this thesis. And the ability for an individual person to do that is completely on that individual person and their ability to go through that process, because that takes a while to get used to. It's very, very frustrating when you get stopped out a bunch of times and then you still have to get right back in. So, and again, like that's what happened here. That's started why scaling in here. So yeah, I think trading something like this on a smaller level is literally entirely doable. You can take every single one of these, and you can take this from a 25 lot to a 1. I keep calling them lots. I'm just such an options trader. From 25 contracts to 1 contract. You could do 1 contract, 1 contract. Well, probably a little bit more because I just wouldn't scale in with RTY. I would keep that out of the equation. So you could do I was doing contract again. Damn it. No, contract was fine. It was lots. Now I'm all fucked up. So I would do 1 contract, maybe 2 contracts, right, to simulate scaling in with something that's bigger, whatever it is in terms of the scaling protocols. But yeah, it's completely agnostic to the overall trade size. Mike says you have hard all stops, not scaling. Yeah. So in this case, I'm using stop, get out. This applies to absolutely everything. And again, the reason why I'm doing it is because I don't want to scale out, because I know I'm just going to get back in if it behaved correctly. So if I didn't know I was going to do that, then I would be incentivized to scale out. Or something like, if I was going to hold these really long term, because futures are these are marked to market anyways. So there's no long-term capital gains. Like well, there is, because there's section 1256, but like if I hold it for a year, it's still section 1256. So it doesn't matter to me. Plus you can't hold it for a year because the contracts don't last that long. So I'm completely fine with binary switching. The thing with people that try to scale in and out is typically to try to reduce some sort of tax implication. That's generally speaking, the only reason why that would be even remotely advantageous in a scenario like this is to try to decrease the number of transactions. But that's, again, not the objective, and it's not the product that I was trading at all. So those things actually don't matter to me in this context much at all. But it's a great question. We had to take a little more acetaminophen. I still don't really like this peach strawberry. It's kind of weird. Not a big fan. We'll get through it. Mike, does that make sense? And Tommy says, I like your process of gaining confidence and conviction to scale in heavy. Oh, yeah, definitely. The name of the game there is trying to have a really, really productive way to build risk. Like, that's the way I look at it, is how can I absolutely build risk that represents the thesis? Because again, like even with this last entry that massively scaled my notional value, again, another $1 million. And I think in this case, by adding $1 million in notional risk, I literally am reducing total risk by the position that I have. So for me, the process of scaling in is actually quite easy. I think the problem that people have from a mindset perspective is the idea of saying like, damn, like I don't want to scale in and have this trade that's showing a $15,000 profit turn to a $2,200 loss. Well, I don't care. Because even if I take this $2,200 loss, again, like as long as the thesis continues to play out, like I'll just get right back in again. And I literally did this yesterday on the YouTube live stream. That's when I put the thing up that shows like the holding screen or whatever. And I straight up went through and built a new position. Why the fuck not? Yeah, for sure. Reese says, I tried a similar thing, but guess I was wrong when it pulled back. That's really interesting, because when I look like this is a fairly unilateral move, which is fascinating to me. Like this is very one directional. I was fully expecting to get stopped out at some point, fully expecting. And the reason why I was fully expecting that is simply because when I look at the movement, like I didn't expect it to open up quite as much here. So I thought that there would be at least some sort of partial retracement. And that's why I was using fairly aggressive stops so that I wasn't giving up too much of the profit. But also just because that's my expectation and I think it's highly likely to happen, I'm still going to trade what it's doing. And that's another really important note for traders, because we can get too wrapped up in what we think may or may not happen, should or shouldn't happen. And really what matters as a trader is what the fuck is happening. So even though I felt that that was the case, because the other thing a lot of traders do in that instance, and they're like, okay, well, after trade 1, trade 2, trade 3, it gapped up. I think it's going to pull back. So I'm going to wait to put my position on because it's going to pull back. Very reasonable assumption. Starts to get really extended. It kind of just ran through this congestion area that it didn't care about and started thinking it might consolidate sideways. Completely fair, but that's not what the price action was dictating to me. So even though that could have been a fair thesis or something else could have been a fair thesis, again, the goal is to trade what it's doing, which is difficult. It's really difficult to do that in the beginning because you do have to get comfortable with the fact that, again, in this case, I'm up $13,000, but then I risk being down 12 grand to continue scaling in. Like that's not a normal thought process. That's a trader's thought process, which is difficult because, again, for me, I don't even view it this way. I'm not looking at it as, oh, I'm up $13,000 or $11,000, whatever. Or 12. I'm up a few bucks and I'm going to, risk all of that gain. That, like, I don't like that. I don't think of it that way. I literally think of it as, okay, by taking $12,000 of risk, I now just grew my total exposure from $500,000 to $2.75 million. I just meaningfully expanded my scale, but I did not kill the risk profile of the trade. This is still, I would happily take this trade over and over again, risking 12 grand to control 2.75 million on something that I consider to be a well-founded thesis based on the research we reviewed in the beginning. I'm cool with that. No problem. I'll take it. Reese says, need to refresh the mentality. Yeah, it's tricky. And trying to make sure that there's a solid approach to, again, to make all these pieces come together, because you have to think about it. What goes into this kind of trade is not just the idea of the trade. Like, there's a ton of these different components that come to the analysis, the thesis, the scaling protocols, the stop protocols. So it's like, it takes a lot of small things coalescing together to then build something like this. Yeah. Joey says, was this your first ever $100,000 bagger? No, definitely not. I've had quite a few of those. But this one, again, I just think it's a pertinent example. And if you go through a lot of my trade reviews that I offer on the YouTube channel, I spend so very little time going into that stuff because I just think it's the wrong focus for people. I give it to people in this kind of context because I know that natural curiosity is there and kind of what the scale can look like, what things can look like. So that's why I offer it. But I also know that the propensity is for people that watch the videos, they tend to start focusing too much on that. And it's kind of counter to the point that I try to share. So a lot of the videos that you'll see in like the trade management playlist, for example, a lot of that stuff is literally just me talking about stuff that's gone like super shitty, which is kind of very normal as I think about it. Goes through pretty regularly that way for me. But yeah, this is absolutely not the first of its kind for sure. Paulo says, how many entries do you usually do? It's not so much a function of how many entries. It's a matter of like, how do I get scaled into the capital? So for example, in this case, it was fewer entries than I would have expected. So like, let's say it's this kind of move with smaller percent price gains, I'm actually going to scale in more slowly. And the reason why I'm going to scale in more slowly is because it's not jumping leaps and bounds. So I'm not going to commit a ton of capital until I start to see it being more aggressively correct. In this case, because it was a little bit of a parabolic move, I started scaling in quite heavy. And again, looking at realizing being late, right? Because again, looking back at this, starting to add the big Russell all the way up here was just fucking day late, dollar short. And it would have been way smarter to start scaling it in on this day. But that's my risk averse nature. I know that that's one of the downsides to my psyche as a trader is I am still what I consider to be too risk averse. And it's not easy to get over that. I think a lot of that, again, not to go into like a fucking, psychology session, but I think a lot of that really comes down to my background, right? Like growing up poor, having a scarcity mindset most of my life. I think that's exactly why I tend to maintain artifacts of that. So I do my best to work with it, but it exists. It's something that I know is part of me. So yeah, it is what it is. At least as far as I'm concerned. So yeah, Paulo, let me know if that answers your question. Vladimir says, I just commented on your video from today about Chewy buyback. It is a pattern and not what appears at first glance. Interesting. I don't follow Chewy too closely, but yeah, I thought the overall movement there was kind of interesting. Off Putin says, I'd bet $1 that he has plenty of $100,000 gains. Yeah, I definitely have had a few of those. Elong Song says I'd bet way more than $1. That would have been a solid bet. That would have been a solid bet. Sorry, you guys could have made a market really fast. Reese says I started the position in August trying to front run. Yeah, that's the tricky part, is because especially in the beginning of August, a lot of that move wasn't even because of some material change in the Fed. That was like a broad market move. So this, again, that move shaked me out too. You're not alone, Reese. In this case, I absolutely had a similar experience where I had built the position, started to build the position, and then it failed me pretty quickly. And even up there, I ended up getting stopped out even faster than I wanted up in this. So I could not agree with you more. Now, again, the difference, I think, it seems to be between the way that we played it, though, is that as soon as things started what I call behaving correctly, but it's just more so kind of like doing what I'm anticipating a little bit more directly, I have absolutely no problem getting right back in. I will happily enter right back in. And that's a tough thing. I'm going to start scanning for what's for dinner. I think we might there's this cool burger place by us that I like a lot. I think I'm going to go with that. I'm feeling some American burgers to counteract all this Mexican food. But yeah, I think that's one of the difficulties for traders to adopt, is the ability to pivot that way, because I definitely think it's a little bit unnatural for folks, like the first couple times you do it. But it's something that you get used to over time. But you have to break a lot of bad habits. Like, most of us approach the stock market with a standard consumer mindset, which is actually awful. It's one of the worst possible things you can do, because the markets don't respect that kind of psychology, and it doesn't work well for traders. For investors, it's different. If you can find things at a really great value, like Warren Buffett does, or even Michael Burry, that's another thing Michael Burry does, is a big part of his approach, is looking for things that he thinks are like severely valued wrong, and then trying to speculate in those a little bit. And the way that they control their risk, because they scale in very heavy, is by having something with a proverbial low floor that's not that far from their entry, right? You gain a good entry. So for something like that, I totally understand the approach, but for trading, it does not work that well, I don't think. Off Putin says, Eric, for you, is trading similar to learning everything about playing guitar and then forgetting the details and going by feel? No, absolutely not. Absolutely not. There's a massive amount of subconscious processing that I know that goes on. It kind of is like from that book, let me grab it, Blink by Malcolm Gladwell. And Blink talks about the subconscious processing and how fast we process things subconsciously. So if you take a look at, I literally bought the book. That's actually funny. So if you take a look at Blink, you can see that really what it talks about is the way that our brains process things, and how much of that processing happens subconsciously, like super fast, based on the total breadth of all the information we've ever seen throughout our entire history as human beings. And we're very good at this subconscious processing. So I would absolutely argue that there is a massive amount of feel associated that's subconscious for me. Now, I still demand that I quantify and qualify things, right? So like, if you think about the origin of the trade that we just went through, like I said, I probably did about like 6 discrete hours of research on this precise thesis. And that's on top of, I quote it all the time, it's probably closer to like 35 or 36,000 hours of studying markets. So that's just another like 6-hour block on top of all of that. So there's still a demand for myself to always question and challenge my underlying assumptions. And it's because of how fallible I know the human mind is, and how easy it is to fall into like really specific bad thought patterns. So again, this is why I keep this on my website for you guys, is you can literally read through and see all of these different mental shortfalls we exhibit as traders. Well, really as people. This doesn't apply just to trading, but I think the broader point here is I never feel fully confident that I am, completely absolved of these different issues. So there absolutely is an element of innate feel that comes in with it. I noticed that a lot too with smaller time frames, like even during the FOMC statement. When that was coming out, I was going to trade 0 DTEs and I was like, I'll wait till it starts. I think vol's high, and then vol was high and it just looked like it was moving weird. So I literally waited, and I'm thankful that I waited because I would have gotten stopped out. I would have got ran over. And that was just a completely subconscious processing that I generally respected because it falls within my rules. That's why I always remind people that the trader has the last say. It is always ultimately our choice. And it's also why I am not a subscriber of like mechanical trading. I think it's fine. And if it works well for some people, I'm totally cool with that. Trade mechanically. That's awesome. But for me, I actually think discretion is a massive weapon if it's trained for good as compared to bad. So yeah, it's a really interesting question. And it's something that I think quite a lot about, actually, as you can tell, because it's a really curious juxtaposition between processing, especially in something that is so fallible by human emotions. So yeah, I think that that's solid. I'm going to take a quick 1 minute break and let the dog out, and I'll be right back. He took off like a bandit. He was like, yo, he was ready to get out of here. So I'm glad. Thank you guys for letting me let the pup out super fast. He'll probably be back scratching at the door in just a few moments, but all right, let me see what else you guys got. Paula says, do you ever use trailing stops? No, not ones that automatically set. I'll move stops all the time myself, but I do not, I do not personally use trailing stops. I don't think there's anything wrong with them. But the problem is like, I don't use stops based on arbitrary percentages off of the stock itself. Again, you can tell by the way that I set stops differently during this move, sometimes based closer to the open or to the close. It's really dependent on the individual opportunity. And it looks like the boss is back. Comes. Here he is. This is the boss of the operation. He's a little bit of a mixed analyst himself. He uses both technical and fundamental analysis. Is that your favorite? Yep. He does like to lick specifically like the nose and the face, but I like to hold him like this because he, here, if you take a look at like his little tiny feet, very stoic. He's very stoic right now. The best little dude. But yeah, I think trailing stops are fine. I just don't use them. I kind of mentally move my stops or physically place them depending on what the opportunity is and what I'm trying to capture. But yeah, trailing stops to me typically are too random, right? They're generally based off of a certain threshold off of spot price. And I much prefer to use support and resistance because the goal is to use stops to capture and maintain profits and not get stopped out too fast. And if you use kind of a random percentage threshold, again, as a trader, you tend to offset that a little bit too much. Now, it's a little bit different if you are like an investor. I think that that's okay. But yeah. Paulo says, how old is Thor? He's 4, I want to say. I think he's 4. So he's still a little bit of a youngin', as they say. He's getting into his OG years. Mike says, oh no, Joey says, inspiring to know that there are trades that can be outsized successful by keeping the same risk profile or smaller routine trade. Yeah, exactly. Definitely. And that's a big part of the way that I choose to scale into things is exactly for that reason. Because a lot of people, when they start scaling into things, they're doing it with the mindset of like, okay, like I'm building risk and this is becoming more and more risky, which is not entirely wrong. It definitely is, because there's always the oh shit factor, right? If something just catastrophic happens for whatever reason, then I get a terrible fill or whatever the case, like that is absolutely a thing. But it's also entirely possible for it to flow generally okay. And if we size trades smartly, we can structure them so that it does reduce risk as we're building our position, which I do think is, again, just a general important note for people, because it's easy to get wrapped up in the mindset of, you know, as I'm putting on more risk or increasing my position size, I'm taking bad risk or, you know, moving my risk in some sort of bad direction, which is not inherently the case, again, in my experience or in my opinion. But if you don't do it right, then it's absolutely potentially a massive problem, like an absolutely massive problem. Because, for example, like if I scaled into Russell here and I kept my original stop, the risk on that position would be massive. Actually, I'll do the math for you really quick. So I scaled into the Russell when it was like 2207 up here. So let's say, for whatever reason, I had kept my original stop down here at like 2101. So when I add that position with the other positions, so for that Russell trade by itself, that would take my risk to $107,000 if I had kept that stop, which obviously would be catastrophic. That would be a terrible choice. So yeah, the process of scaling is really, really nuanced. Yeah, you have to be like super, super nuanced. Robo says, assuming stops are in at a good spot for P&L ratio, aren't you missing out on profits overall by scaling in? Definitely. Absolutely are. But you're also decreasing your risk. So that's the trade-off I make. So Robo, your point is exactly correct, right? So like, let's say here, I chose to scale in with the entire trade. Well, then I would have a absolutely massive win compared to what I ended up with. But again, if I scaled in entirely on this trade, even if I take a ride from here down to 2089, and that's where I chose to get stop out, that's still going to be a kind of nasty loss. Because again, as I'm adding more risk, I'm using the proceeds or the unrealized profits of prior trades to decrease my overall risk. If I don't do that, and I just enter the entire position up front with a stop, I then have to set the stop even tighter, which again, like this is a tight stop. And one of the biggest issues you're going to have as a trader is if you get to the habit of setting stops or your exits, it doesn't have to be a stop order, but your exit too tight, because you're just going to get chopped up. You're going to continue to realize losses because you're not giving a trade any breathing room. But then there's the other problem. If you set your stop too wide, then you start getting punched in the face every time you do get stopped out. And that's where you have a smaller number of losing trades that starts overwhelming a larger number of winning trades, which is quite problematic. So with something like stops scaling it's like everything else with respect to trading. It is very, very, very much, in my opinion, about balance, striking a really effective balance between what we think we want as risk, what makes sense for our risk, but then also for me, as I'm scaling in, I'm able to use the unrealized gain to actually decrease my risk as I'm actually increasing my total exposure. That's the dance, at least for me. Axe says, what stop losses do you put for a given trade? It is entirely dependent on the trade. Yeah, there's not really a set answer to that. It's entirely dependent on the trade. And as I mentioned before, Axe, let me know if this makes sense. But in this case, I essentially am using support and resistance. That's most often what I'm doing. And then I actually have a video about risk, I think. Yeah, here. There you go. Akshat, this video is for you, my friend. So that video is about like risk management in options trades specifically, but applies to anything. And the cliff notes of that video is essentially the way that we're able to balance taking an opportunity to make money, but making sure that the risk is controlled enough, but also at a corresponding reasonable probability so that we're not getting stopped out a bunch of times. So I define typically like a total risk as a percentage of the portfolio that I'm willing to allow a position to get up to. And I'll go off of that and make sure that whatever I'm building aligns with that. So let's say, for example, the total risk I wanted on this trade, let's just say, for example, let's say the total risk I wanted on this trade was $5,000, whatever it is. Okay, so this one passes the sniff test. This one passes the sniff test. This one doesn't. So what does that mean? Well, it means a few things. If this needed to be no more than $5,000, then I either need to change my stop, move my stop up. If I move my stop up, the probability of getting stopped goes up. So then if I don't want my probability of being stopped goes up because this is already a pretty tight stop, then I need to trade at a different size. So in that case, rather than doing 20, I would have to scale this down to something else. I would have to do something closer to like 10 so that I can essentially cut this in half and then fall within my risk tolerance. So I entirely view the aspect of controlling risk, setting stops as trying to do a really delicate balance of sizing things so that it makes sense with respect to the portfolio. That's a good question, though. Reese says, which common pitfalls do you have to overcome and are still struggling with? I think you're referring back to this, and yeah, let's do it. Definitely not this. I'm over this. Definitely not 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 this. I don't think this anymore. I don't think this either. I actually think I actively try to look contrary to my opinion on a lot of things. This is probably true. This is probably true unless I have something to quantify it for me. So I would say the biggest one definitely is scarcity. I would say the second two that I see here, anchoring and hindsight, both are very true. I don't think this. I don't think this. I don't think this. I don't think this. I think this for sure. So I think the availability heuristic attacks all of us. So I think that's true. Sunk cost fallacy, absolutely not. Illusion of control, I do not think so. FOMO, I don't think so. Gambler's fallacy, I don't think so. I don't think so. I don't think so. I think this. Recency bias. So I would say recency bias comes to mind for me. Availability comes to mind for me. Hindsight, anchoring. I don't think any of them are really that outsized, to be completely honest, because I force myself to look again. Like that's why when I was coming up with my overall thesis for this trade, I forced myself to do that 6 hours of discrete research to just see what actually was. But I would say those are probably the main ones. I think that was Reese. Let me know if that answers your question. Uh, Mike Will says sick means single income couple kids. Do you think your thought process works longer term? Mike Will, sorry. Let me know if what that was with respect to. My bad. Joey says, got to get some elevator music while we wait. You know, that's actually a good point. When I have to take the bathroom breaks or like let Thor out, what I need to do is get some of my drone footage up from these different places. Cause I think you guys will actually really, really enjoy that. I would be 100% down to do that. Ree says, I'm relatively new to using hard stops and defined profit targets, but I've gotten stopped out almost exclusively before it goes up. But I have my stick to the stop loss and then regret it. Yeah, that is such a great question. So for you, Reese, and actually in the meantime, let's grab, I mean, since we're just kind of bullshitting right now, answering questions, let's grab a drone video. I'll have to mute it. Do you guys want to do, let me know what you want. Do you want to do Kauai? Do you want to do Caramel Big Sur? Do you want to do Iceland? Or do you want to do Norway? Those are our choices. We have Norway, Iceland. Well, I have more than that, but I think those are the ones that you guys would like. Vladimir says, I enjoy drone footage of... Well, the problem with that is the good old drone footage typically leads to not getting the drone back. So I personally prefer to get my drone back. I have to be honest. But yeah, I think the Ukraine-Russia drone footage definitely is also slightly entertaining. Iceland, Norway. I see, okay, so I see 1, 2. I see 2 for Iceland. 2, we're literally split 50-50. I love that. That's hilarious. So we need one more vote. With one more vote, we'll be able to... Shit. Looks like Iceland probably wins. Oh, shit. So, I literally think you guys are straight up tied again. This is hilarious. I'm going to do a poll. Let's do drone video. So there's Iceland, there's Norway, and then there's Alaska. And I don't think anybody cared about Caramel or Big Sur, but we'll throw that in there. All right. So got to do a poll because I literally think that we are like straight up split, which is absolutely hilarious. I have to be honest with you. And Alaska was really cool. I like that one. Yo, you guys are like still almost split. How funny is that? All right. It looks like no, it's Norway. Norway's winning. Paula says, did you do the video where the Russian waxed the drone with his shotgun after run? Yeah, I saw that one. I saw the other one where an FPV literally dropped ordnance on a dude, and then the dude just like, because he was already wounded, which is kind of fucked up. And then he literally just threw out, like laid down and threw it. All right, so it looks like Norway. So we'll grab the Norway video. I have to mute it right away because otherwise I'm going to get copyright struck as soon as it starts. And so there's the mute. So yeah, I'll just leave this on in the background while we're bullshitting. Okay, so I'm going to end this. And then let's get back up to the top. Mike says, how many similar opportunities do you generally see over the course of a year? That's like super, super relative, to be completely honest. So when I think about that, and I'm going to pause this and take a peek over at the platform so we can talk about that, is now one of the studies that I'm running is what's the probability of an outsized moved based on a subsequent cut and the pricing of that. So do I think that there's going to be future opportunities for this? Absolutely. Do I think that they might be as pronounced? Absolutely. But I also have to be really, really careful with things as they're coming out. So I think that there will be more opportunities like this. And I fully anticipate trading them. I think the election is going to be another opportunity like this, because what will happen, in my opinion, with the election is as we get closer, we're going to see the market start to price in who they think is going to win, whether it's Trump probably up, Kamala probably flat or down a little bit. Don't know, but I would imagine Trump probably up. So if the market starts trying to front run that move, it will be very similar to this, actually, where it front runs the move. And then when the event itself happens, there's probably a bit of a follow through move. And this is stuff, again, that I typically will go through with the Patreon folks, because I like to study these things. And what I'll do is I'll run a study that looks at the lead into the elections, which I already have for the last, I think I have 50 years, but I have it 50 years. And I think that's by design, because when I add the century, I like to use 100 years because it sounds cool, but it's a little too skewed. So for the past 50 years, I have that. And then plotting the outcome, not based on the candidate's party or anything, like I don't care. But what I care about is what's the move leading in, right, as kind of the signal, and then what's the move on the back end after the move itself. That to me is interesting. So I think what we'll find is very, very tradable events when we're looking at the election itself. And I think that the election can also be traded from a volatility perspective, because the market will increase volatility leading into the election. And there's a really good chance that, like, I probably won't trade the volatility leading into it personally, just because at this point I don't need to on the year. I'm already up pretty meaningfully. Even before the last couple days, I told you guys I was up already over like 30% on the year. So I probably won't trade the volatility leading into it, because it's a little bit annoying. You have to, monitor positions. And in order to like really do it, you have to delta and gamma hedge to isolate the vol. But I do anticipate trading the follow through. That I think for sure, which is a great question though. So yeah, let me know if that answers. And let me see if I'm all caught up. Paulo says, if I missed a question up above, let me know. And then I'm happy to answer it. We'll go back to Iceland. I think to Norway. I think Norway starts getting interesting here. Oh, this place was really cool. So this was on the way when Mel really wanted to see this, not this place. This is, I guess, like one of the biggest wood hotels or some shit like that. I don't know. But Mel really wanted to see this spot that's coming up. Well, not this. Well, you'll see it in a minute. But there was a really cool spot that I guess was like the Harry Potter bridge. It's a little further than here. But let me get back to your guys' question. Paulo says, did you see the video where the Russian waxed the drip? Yeah, I did see that. That's absolutely awesome. Tommy says, you can talk about your earnings play in Meta that you took a chunk of change. Might be that was last year. With respect to what? Like, I obviously remember details of the trade, but is there anything in particular that you want to hone in on for the Meta trade? There's those kinds of things. Again, to me, there's just like kind of standard fare almost. It's not Meta directional trade. How did you build conviction? I see. Yeah, that's a good question. I actually would probably have to refer to the video. I don't even know where that was. I don't remember it. I'd have to look at my trade log because I literally don't remember all the individual details on it. This is, by the way, the Harry Potter bridge that I guess this is like actually for the movie Harry Potter that they shot this train bridge, which is pretty cool. This is it. That's pretty neat, isn't it? I thought the bridge was legit. But yeah, so I can talk about the idea of like building directional conviction, writ large. And the way that I look at it is, again, it's a function of risk, right? So right now, actually, an even better example than Meta of last year is a trade that I have on right now, which again, I'll pull this video back up when we can bounce between back and forth. But if I take a look at, really there's a couple, there's Home Depot and Waste Management. So Waste Management is just short puts right now. So no, that's a lie. It's a short strangle. But so for something like this non-directional trade, it's the same process as developing like some sort of thesis that's tied to a directional disposition. So what I'm doing is I'm trying to analyze the bulk of price movement and behavior. And then I'm trying to think about what I think is most probabilistically going to happen. And then based on that, it will impact how I choose to structure a trade. So then for something like Waste Management, which is, again, a trade that I have on now, the overall price movement, as far as I can see, has essentially been range bound sideways for a hot minute. Realistically, from post earnings, it's stabilized somewhere in here. And I would call it from this day forward, essentially the 5th of August. It's just been running sideways. So for me, in developing, in this case, a directionally neutral hypothesis, but still directional, right? Neutral is a direction. And as I'm looking at this, I think, okay, I'll structure the trade, put it on. Now, the strategy matters a lot because in this case, I'm running a variance risk premium play. So I'm not going to scale in, scale out. I'm just going to kind of leave it as is. Now, that's not the case with other positions that I have on. Another great example of this is the S&P futures. I've been scaling into this from, again, the drop that we had back in August, but this is for a completely different thesis. Now, it did move sympathetic with the rate cut, which again, I generally expected to a degree, not massively, but the idea behind this one is I just thought that this was a great value to get in at the S&P 500. And then I just want to run the S&P 500 for here. So what I do is as I see it start breaking up above, I will build a position and then I will slowly scale into the position as it continues to move in my favor. And then as things start to level out like here, and for these kinds of things, I actually use this indicator quite heavily, which in this case, it's when I say this indicator, I'm referring to oscillators. In this case, it happens to be the RSI right now that also has a moving average attached. I really like this setup. So I use a 5-day moving average to smooth the RSI. And then I trade essentially the relationship between the two. But in this case, as soon as I see RSI starting to level out, then I'm not adding anymore. I'm going to wait. And again, it's not just RSI. I'm looking at price action, which I can also see is clearly leveling out. And I'm just going to sit and wait. And then as it starts declining down, I'm also going to sit and wait for something like this if I'm generally built in. But let's say I was starting to build here and I hadn't built a bulk position yet. Well, in that case, I'm actually going to scale pretty heavily on this down move, again, depending on where I think near-term support may or may not be. But in this case, since I already built bulk position here, I'm just slowly scaling in. When we start trending sideways, I start to hold off. I'm not adding a whole lot. Then as we're coming down, I'm not adding a whole lot, contrary, again, based on the context to what I would do in the other scenario that I just outlined. And then as it starts to level out, and again, I'm just kind of running this against what I'm seeing in terms of volume. I'm looking at the moving averages. I'm looking at price. And I see the RSI starts to level out. And then I actually see the RSI poke back up again over the moving average, typically some sort of change in momentum. And then I'll start scaling back in again to achieve whatever the desired exposure is ultimately. But I go through cycles of taking profits because I'm not trading the full covered strangle here. I'm kind of trading more so something similar to like a ratio covered call. I do sell puts as well, but I treat those a little bit differently. Again, because when you're trading something like the S&P futures, they're not future settled, they're cash settled. So you can't like really trade the covered strangle, which is really what I would prefer to do in something like this. So yeah, it's a good question. And I think for something like this, I think a lot about how can I get into something that represents the way I think about the market at a given point in time. That's kind of the general thought. Off Putin says, I met a Norwegian in Medellin Colombia that was talking about the price of a beer or a nice meal in Norway not cheap. Yeah, Norway definitely, it didn't strike me as cheap. It wasn't like egregious, right? Because I'm also used to California. But I do remember, like, because we like to stay in decent places when we travel, we're kind of spoiled. And I do remember, like, a lot of that stuff was a little more expensive. We don't really drink that much, so I can't comment necessarily to the alcohol. But dinner and stuff like that definitely wasn't cheap either. I don't remember thinking like, oh yeah, this is like super cheap. But yeah. And Jado says, damn, just got here. How much did I miss? I'll let the chat tell you. I feel like we covered a lot of ground, but they'll let you know. Paulo says, how many DTE on WM? Yeah, I could tell you right now. 1 sec. I gotta pull up. Oh, wait, I can just grab my log. So for WM, those, when do those expire? I have to log in on my, on the Thinkorswim web browser so I can see my stuff. Give me 1 sec. And WM, those expire 29 days to October. So that would have been like a month trade, essentially. Yeah, about a month. GC says you missed everything. Yeah. Yeah, we really broke down kind of the entire process of trade. So yeah, I think that there was a lot that we covered in there. All right, so the next thing that I want to talk about before we wrap up, and again, if there's any questions or anything that you guys want to dive into, let me know. But I want to talk about the market writ large now. And the reason why I want to do this is because I think it's just like a really, really pertinent point. And it's something that I am considering really heavily. I'm just saving this and closing it. So let's talk about the market as a kind of a large thing, right? Just looking at the market as a whole. I'm going to go into my flexible grid so that we can start with a little bit more of an in-depth analysis. So what do we see? From a broad market perspective, there are a few things that really stick out to me. The first one is the S&P 500 is still leading. The second thing is the Qs are actually still lagging, in my opinion, on a relative basis. And we actually now see the Russell almost breaching highs. So what's happened now is the lead between large cap and small cap stocks has changed a lot. Here's the deal. Most of the year, the Russell was flat or even negative slightly. The S&P 500 has been hovering somewhere between 16 and 20%. Now, year to date, the S&P 500 is up 20.9%, and the IWM small cap is up 12.32%. So right now, what's happening is small caps are aggressively closing that gap, And that leads to a lot of short-term movement that, again, we can capitalize on as traders. So I think in something like this, when I see large caps doing what they're doing, I think we're going to see a few things start to happen. And again, you can see it in the volume, right? Take a look at the sale volume in Qs here. Sale volume in Qs is over 50% of the daily volume. Take a look at the sale volume in IWM. It's minuscule. It's like a fifth of the overall volume. Because what I believe is happening is people are starting to come out of tech and they're coming in to things like IWM and small caps. And we can take a look at this a little more closely. Let's grab this and let's take a look at this and let's take a look at this to start. Oops, wrong one. Sorry. My bad. Oh boy. There we go. This is what I want. So if we take a look at overall movement, I actually think I need to widen this out a little bit. Give me 1 sec. Here we go. Okay. So if we take a look at the overall movement of things, we can see that from an institutional perspective, we can absolutely see that we're still seeing, concentration in some of the tech names, but not anywhere near as many as we've seen before. So if we look back and we take a look at things like UNH, XOM, UNP, AON, Ulta, we can see that we're building into stuff that's not super tech heavy. And then if we take a look at things that are being offloaded and declining, Apple, Amazon, Meta, like a lot of tech names. So, and this is something that we've talked about a little bit already, that we can see the change in overall sectors and the continued contraction of technology in a lot of these portfolios. So I see financial services still expanding, and I see some of the other more cyclical names starting to expand. So that doesn't tell me that tech is dead or, there's no play in tech. I definitely don't feel that way. But it does tell me that it's not quite the same as what it once was. And if we take a look at the sectors, you'll see a few things. You'll see that tech is looking better, but tech is at a really, really dangerous spot now, where you can see that we have a high posted here, a lower high. This is still a lower high. So this is not any sort of counter trend move. This is what I would consider to be the starting potentially of a counter trend move, but it's too early to tell. It would need to base out here and show strength, which it's a little early to tell if that's what it's doing. But what I can tell you is that XLF continues to crush it and it's running back up near highs. I can also see things like XLV that are doing well. I can see XLU is contracting, but still this is a point where it can still grab a bite and consolidate. XLRE is starting to run sideways. XLP contracting a little bit too much. I think if it doesn't start running sideways, I would call it a counter trend. XLB is still rallying. XLC still rallying. So there's pockets of strength scattered throughout the different sectors, but it's not unilateral and it's not focused in tech. So when I'm searching for names, that just tells me I'm going to be really discerning, which we're going to talk about, because I need to figure out where I'm going to start allocating more capital, because my portfolio right now as it sits, again, this is normally what I go through with the Patreon folks, is kind of like spending a little more time selfishly looking at my stuff, but I think it's because it helps people. So right now I am 170% utilized. That's using notional exposure, and that's also including box spreads. And I have box spreads right now out in 18 October, and those are priced at 0.4% over the risk-free rate from where I entered the position. So that is essentially what's going on there. Now, and I'm actually, one of the reasons why I did that for, again, general context, is I had a position in HYG that I took down. And the reason why I took that down is because I wanted to get into box spreads before the Fed rates started changing and then impacting things. Sewell Joe, thank you so much for the $1.99. Really appreciate it. That will go towards my dinner tonight. Says, Chewy news today, up or down? Thanks. Yeah, it's a good question. I think in terms of Chewy, it probably still looks like net sale pressure, right? Because they announced that there's, and again, there's a video, I'll share the video for those that haven't seen it, about the move itself, or kind of the quote unquote offering. School Joe, this one's for you. And so it looks like right now Chewy's essentially they have an investor that's unwinding 500 million. And it looks like Chewy's going to scoop up 300 million of that. They still have their 500 million buyback going on. So I think that's why you see the pressure that's being exhibited on it now. But it's still in a bullish pattern, in my opinion. So I'm not like bearish or anything in Chewy just yet, but I don't have a position in Chewy, to be clear. I'm just talking in terms of sentiment. But I think it's kind of a watch, right, to see how it decides to behave from here. I fully would expect it to do some level of consolidation within this range. And then if it ends up eventually, basing out and popping back out, then that would continue the bullish trend, in my opinion. And then if it starts falling below these highs, then I wouldn't necessarily love it to the upside, at least for a new entry. And for me, you can see essentially where I would place my stop. The way it would work is like if there was an entry somewhere in here, stop would be at the lows or at like the 200-day. Then as it's running up, pretty much once it gets above here, this becomes the stop, like right there. Then it continues to run up, bases in here. This is a completely fine stop to use these lows, or even this if I wanted to be more aggressive, which I probably wouldn't do. I'd probably use these lows. And then as this pops up, declines back down, I think those are still fine. And then from here, it depends on how bad I want to protect the profits. I think that's a fair stop. And I think this is a tighter, but also a fair stop. So yeah, that's kind of what I see in here from a general holding perspective. But yeah, I don't have anything in Chewy right now. And let's see. I saw another question. Reese says, big shout out to Eric for letting us into the stream. I'm just a voyeur on a branch. Yeah, that's awesome. I'm glad. And again, like the main reason why I think I wanted to open this one up is because it talks about the entire process of a trade, right? From research to prior positioning to the trade itself, the management of the trade. And then ideally thinking about, most importantly, the most important thing I want people to take away from that ideally is the process of scaling into a position, but using scaling as a way to increase exposure, but also reduce risk simultaneously. And again, it worked beautifully in this scenario. There's an entire possibility where you get stopped out if your stop is too tight, and that can happen. But even though that it didn't happen in this case, it wouldn't really change much of the scenario because the process would be to scale back in. So yeah, I think hopefully that's one of the bigger takeaways there. Paulo says Oslo topped the rankings of the world's most expensive cities a few times. Yeah. And the funny thing is like, we didn't like Oslo. We cruised through Oslo. We had, funny enough, I realized that we have this really, really funny habit where whenever we choose to stay somewhere that's like technically a little like extra bougie, we tend to leave and not like it. So we had one night planned in Oslo just to go check the city out. But at that point, we had already traveled all over the place. So let me grab Norway to show you. So at this point, I'm going to turn that off so it's not so noisy. So at this point, we had already gone and done like all this stuff. We already did Geringer, like we went to Andelson, like all this stuff. And we came all the way down the coast over here. We went through Bergen, and then we took a little bit further south, and then we took kind of this trail over here. And then, so the game plan was to stay in Oslo and then to bounce. And we ended up we left Oslo and we went and stayed up by this lake over here so that we didn't have to stay in the city. Because when we're in like out and about in like nature mode, we really don't like going into cities. Even Bergen, funny enough, we didn't stay in Bergen. We had a hotel booked. This is actually, now I'm thinking about it, this is hilarious. This is where we had like a really nice hotel booked. And we checked into the hotel. We like walked around for a little bit and we're like, dog, there's just way too many people around this. Like, we are not having it. We literally left and we went and stayed on a fjord. We went to Eidfjord. No, we went somewhere on the way to Eidfjord. I was one of these in here, but that was actually super hilarious too. So yeah, the two primary cities that we had booked, we did not stay in. Now, the one that we really, really liked though was this. This was a gorgeous little city. We had a giant, like great time there. It was absolutely perfect. Big fan. Big fan. But yeah, we ended up not staying in many of the cities. Off Putin says, I'm liking T triple Qs the past 2 weeks. Yeah, I used to run a bit of a strategy in there. I mean, it looks like it's gaining a bite. I mean, the problem with T triple Qs is that it's still just lagging, not doing well. It's realizing way too much volatility. It still hasn't even gotten back to prior highs, let alone even term highs here. And again, like that's the problem with stuff like this is when you look at, again, T triple Qs, it's underperforming pretty significantly compared to everything else. Because if we take a look at, again, like even QQQ, it's still not at term highs, but those term highs are still higher. I gotta go out further. Are still way higher than essentially the prior highs that it posted. So the fact that it's running all the way up like this, it just tells me that the volatility decay right now has been really unfavorable to T triple Qs. I'm glad I'm out of it personally, but yeah. Reese says thoughts on PayPal. Only a share position, luckily, but let's see. PYPL. I mean, it looks fine. To me, stop is somewhere in here. Like first stop would be at or below this. And then second stop would be kind of at or below this. And then hard stop below the nearest source of like actual congestion. But for me, it's like, this isn't where I'm entering long personally, but this looks like really solid post-earnings announcement drift that's underway. But yeah, it looks okay. Off Putin says T triple Qs was up over 9% intraday today. Yeah, that's okay. T triple Q moves, man. Like that's the whole point. But what I can tell you is T triple Qs is literally still down from where it should have been over here. So I think the problem with something like T triple Qs is, again, like focusing on the percent return that it makes in a day literally is superfluous. It doesn't matter. What matters in something like T triple Qs is the sequence of returns, because it can have really good days, right? Like if we take a look at this, the total range high low was 56 to 48, almost a 10-point range, almost 20% in a day. But this doesn't really matter, right? Because this happened after all of this. And it still wasn't able recently to even come back from the move that we saw mid-July. So yeah, I wouldn't care if it moved a lot in an individual day. It doesn't matter to me. What like you can trade something like Russell futures or NASDAQ futures that moved less and then just make more money. Entirely possible. But I also don't hate T triple Qs, to be very, very clear. T triple Qs, I used to run a bit of a rotation strategy in it, and I like it for longer term holdings. I've rotated out of it in most of my longer term accounts, and I've favored SSO. But yeah, I have no beef with T triple Qs. I think it's completely fine. But I do think that it suffers massively from its construction. And if for whatever reason it's not a favorable period for tech, which we don't know exactly what that's going to look like going forward, then T triple Qs looks really bumpy. Oh, that's a tough name. Semi-Christian. Oh shit. Semi-Christian. Let me know if that's right. First of all, thank you very much for the $5. I realize what I'm going to do with when you guys donate on here is I'm just going to give it to since I always buy DoorDash while I'm on these live streams, I'm just going to give it to my driver as a tip. I think that'd be kind of cool. So thank you guys. And Semi-Christian says thoughts on a trade as a hedge of sorts. TLT 115 Paul. Let's see. TLT. Well, I can already tell you I don't like the 115. I also don't like TLT now, the upside personally. So I would need semi-Christian. Can you give me more context on what the position is? Because like as a standalone upside trade, I don't like it right now. As a standalone upside trade, I would want to see it going the other direction. So I would want to see it breaking above this handle, which I'm just using a volume node here. Christian says speculative. Yeah, but you got to give me a little more detail than that. Is there like a specific portfolio need for this? Like, does this fit into your portfolio and do something particular? Because you brought up as a hedge of sorts. So like, what are we hedging and why? Because again, if this is just looking at a speculative directional play, I don't love it to the upside right now. That doesn't mean it can't continue to go up. Again, of course it could, but I would wait until it starts actually going up before I would start getting long something in here, because right now it's just not doing that. So for me, I would essentially want to see it at least above 99, I think. And I think above 100 would probably be preferable. Semi-Christian says, no, came across it from a beginner point of view. I'm playing with options with contract here and there to understand and practice. I see. Okay, yeah. So in that case, this is not what I would do at all, personally. And I have a video for you that might be useful. I have two videos. So Semi-Christian, that's one video for you. And then there's another video for you. I have to find it really quick. I don't remember the name of the video, which is why I have to like scroll and find this one, which is a little more difficult. Not that one. This one. So I think this one is also applicable to you. And then this one is applicable to you. So the main thing that I see with your approach, and this one is also applicable to you. This one's about avoiding 9 beginner options trading mistakes. But the way I look at it is I call it stacking strength. And the whole premise, the entire premise behind stacking strength is trying to look at where I think things are more likely to go and how many things are moving in my favor as I'm going there. So for something like this, I think that the idea of bonds going up is fair. That's an okay thesis right now. But I think right now we can clearly see that these are not going up. So I generally like to wait and see for things to move in the direction that I'm trying to get them to go in versus to try to grab them on the way down. Now, that's not always the case. Sometimes I absolutely will jump in to catch a falling knife, but that's not my go-to. And especially for like a newer trader like you, that's not the way that I would start. That's like a really advanced, highly speculative way to trade. The other thing is, just on a general note, I don't like the 115s. So you're looking at 1220. So I think the 92 DTE is fine. But the problem with the 115s is that they're a super low delta and a super low gamma. So even if you get the move that you want to see, you're not really going to make any money from it. So there's actually another video that I think is appropriate for you that is called Buying Options Smarter. So I just posted that one in there. And that talks about essentially the way to think about and calculate what you want on, like what you want to see in the product to move and how you want it to fit what you want. Because I don't really think that this is, like, I don't think it's the end of the world, but I also don't think it's great. I think that there are probably smarter ways to build the position. So that would be my general thoughts towards it. But yeah, let me know if you have any follow-ups for that. But yeah, that's kind of just like my general thought on it, at least to start. Okay. Tommy says running QLD position in UWM. Yeah, let's take a look. So QLD, I like QLD. I trade QLD. And I think QLD is fine. I think I would probably prefer to run QLD if I wanted to trade the covered strangle. And then if I wanted to trade Qs directionally, I would use NASDAQ futures. That's essentially the way that I look at it. But I like QLD. I like the leverage in QLD. So yeah, and I think 2 times in general, like 2 times leverage typically is really solid. So yeah, I like that. And Thomas says, can we look at SoFi? Yeah, for sure. There she goes. So this looks like risk below here, to me. And it looks definitely extended. I don't like that these are starting to contract, but they're still aligned properly. So that's okay. And yeah, I mean, it's not where I get long, but I wouldn't have a problem getting long here. But I just know this context. Like, again, this isn't stacking strength. So if I'm trying to trade a 1 month thesis and I start looking at this from 6 months out, it looks kind of flat. 3 months, it looks good. 30 days, it looks good. So I don't hate it to the upside. I would probably be, let me see. I would probably be just hesitant for the positioning itself. I would probably be quite conservative with something like this. Let's take a look at the options. 1.7 to 9. So massive, massive call skew. That's interesting. So now let's take a look at Benzinga. I want to take a look at a few things because that's pretty big, to be honest. Let's take a look at SoFi. And institutional ownership, 42%. Like this, I don't like to see. Only 1.9% insider. Like I don't love that. And what have the most recent trades been? Looks like buying, which is good. I like that. Yeah, so it looks like insiders are definitely building positions, which overall is good. I like to see that. Yeah, so I don't love it to the upside, but I don't hate it. And the way that I would look at something like this is, where would profit target be? Kind of wide open, isn't it? Maybe something above here, I think would be generally fair. So then the question is, let's take a look at a couple things and like model a trade. So let's take a look at 2 different things. We can look at selling some puts. And again, this is in my pass-through IRA. So the margin requirement will be based off of IRA rules. So in this case, it's requiring the put to be cash secured. And then let's update these because of OCD. And then let's take a look at another model trade. Go to ratio call diagonal. I don't think I want to be in it for 120. 57 is okay. It's a little short, but let's see. 78 delta, 25 cents. Yeah, I think that's okay. Not ideal, but it's not bad. Because for me, I would be looking at this as maybe like a 20-day trade, if that. And then I would look at selling something much shorter term. Maybe those. And then, so that's $800 for those. So then we could do like six of those. So here's what I'm seeing. The first thing is, if we run just a short put, we make $32. We tie up 800. Now, the probability of us staying above 767 into 18 oct $767, like 65% chance of expiring above there. Now, again, the probability of a touch is a little bit different. Because the probability of touching 767 is like 70% chance, very, very high. So then, if we're not going to manage it and we're just going to let it go, or if we choose to manage it, let's say we choose to manage it at 806. So the probability of us touching 806 is almost guaranteed. 92% chance. So from a short put perspective, either exceedingly high chance of getting stuck and stopped, or just not a great fit. So now let's take a look at these calls. And the first thing is to analyze what our risk would be if we get stopped out at that 806 handle, which would only be like $100. So in that case, I would feel really comfortable scaling into this thing really heavily as a, you know, for whatever the account is, or giving it way more room to move. So then we can set a stop much lower. We can set a stop, let's say we're using a $100,000 account. That's kind of the standard that we'll use for examples, because then you can just divide or multiply by 10. And in this case, let's say that we want like no more than 2% risk, something like that's like $2,000. So let's size this up to get closer to that. So then we need like 25 of these ish, maybe 20. Yeah, so maybe something like 20 of them. And then you can sell like 5 or maybe 7 or something like that. And so here, I would figure out like where maybe this 710 handle, like I kind of like that it's below all this congestion. So then what do we lose at 710? We lose $1,500. So we can actually add more of these. 710 gets us to like $1,900. I like that better. And then these will probably just add maybe like one more. We'll do like 8. So now we look at the probability of us hitting that. So again, this 18 oct, what's the probability of us hitting 711? Like 40% chance. So we have a 40% chance of losing $1,800. And let's just say we think first stop to the upside, let's just call it like 9 maybe. Yeah, call it 9. So then at 9, we make 1151. What's the probability of us touching 9? It's 55% chance. So you have a 55% chance of making 1100, give or take. And then you have a 30-ish, 40-ish% chance of losing 1600, I think it was, with the shorts added in, the short calls. 1800. Yeah. So that's an easy way to build that. I do think in short term, we're seeing higher highs, which I like a lot. And that's why I would actually use something around like this prior high, because for me, I probably wouldn't let it ride all the way down to 711 personally. I would probably get out somewhere if it starts dropping below this. That would be essentially exit criteria. And that's just because it's obviously breaking down a ton. And while it's doing that, I would still cycle on the short calls to take more of the short calls down and then to add more short calls. So it would reduce the blow a little bit more. I would scale in more heavily on those short calls. that kind of stuff. And all right, the last one is James says my CZR short straddle 3640 has gone against me. Yeah, I exited CZR a while ago. Yeah, that's just up and out. So there was even more news that came out. Yeah, look at this. Longest winning streak since April of 2021. Hilarious timing. And so now it says launches mobile wagering at Muckleshoot Casino Resort, which is really interesting. Yeah, the move in here has been really curious. I ended up exiting. I had a short strangle, but I ended up getting out here. And that's just because, again, like just looking at the candle, like super strong one-sided move. Again, if it had settled back down, I would have absolutely happily entered back in. But I just had a suspicion that this was some sort of strong move that was, likely to play out to some degree. This goes back to kind of off Putin's prior point about like subconscious processing and quote unquote feel. And that's kind of what that is, right? Like when I saw that, it led me to believe, current pricing was for whatever reason. And it looks like here that like a pretty strong rally up and out. So yeah, I think my dinner just got here, but I do want to run through a couple scans really fast because I do need to add a little bit of risk. So I have enough directional stuff on. I think I would like some short deltas if there's anything that looks ugly. And then, so I'll kind of hunt near some lows. Let's do, I'm going to change this to be within like 5% of 52-week lows. And we'll shop here really fast. WBA. Yeah, like this. I think I already have a position in here. Yeah, damn it. So I'm already short WBA via short calls. So that's not for me. Siri looks good to the downside. So this looks like create an alert above there. And then let's see. Some short calls in here. And let's say a stop at like 29. So that takes us $290. So we can do like 8 of these using the $100,000 sample portfolio. A little less, do like 6. It'd be $1,600. And then 71. 6. 426. So not a lot. I don't love that, but I think it's a really high probability trade. So what's the probability of us hitting 29 by 18 oct? Yeah, it's like 20% chance. So yeah, I mean, that's not bad. I don't dislike that. Probably size it down a little bit more though. But yeah, I don't really have a specific floor target because it looks like it's running on the floor. So I would prefer to sell. And then let's see if there's anything else that's like really trending. So this I like if it starts to rotate back down. So this gets an alert. I wouldn't do anything in here now, but if that starts running back down over, I like it to the downside. EJT still getting punished down. This is an updated alert for that one. And then let's do one more quick scan and then I'm gonna go eat. I want to look at consolidation and then a breakdown. So what I'm going to do is look for something that's moved down at least 20, let's do 15% over the last 30 days. Over the last 10 days, it's remained within a 20% range. And then let's see if we can find some sickly looking stuff. Forgot this one is not built to do downside on the move percent. I have to grab a different scan really fast. Grab this one. And then let's look at this. I'm just going to look for a series of down days. So let's do 5 down days and no turn days. And Sony not like, Rivian don't like, Race don't like, MDB I don't like. I don't like any of these to the downside. All right, I'm going to have to poke around a little bit more to look for more weakness, but we have some things that are dragging down, but not massively. So I'll have to hunt a little bit more, but your boy needs to grab some food and needs to feed the pup. Thanks everybody for hanging out. Hope the session's useful. Tomorrow we have options trading for beginners. As always, looking forward to that. And if there's anything we should cover in there particularly, let me know. And yeah, be an outlier. I'll see you all later.